Okay, let's start this chapter, regulatory framework. So there are actually two topics. One is called regulatory framework and one is called conceptual framework. Regulatory framework, it deals with the structure and organizations who are in the process of preparing and issuing the financial standards, the IFRS. Whereas conceptual framework, we talk about the accounting fundamental principles and conventions which form the basis for issuing the new IFRS. So regulatory framework is the structure of the organizations and the process of making IFRS, whereas the conceptual framework, which will be our next chapter, conceptual framework, it talks about the fundamental rules, the fundamental principles which lie behind the standards. And what we are going to discuss in this chapter, regulatory framework, the regulatory system and the IASB. So let's start the topic. So our syllabus learning outcomes. So outcome number 1, we say understand the role of the regulatory system, including the roles of the International Financial Reporting Standard Foundation, IFRS-F, and International Accounting Standard Board, IASB, and International Financial Reporting Standard Advisory Council, IFRS-AC, and International Financial Reporting Standard Interpretation Committee, IFRS-IC. So these are the 4 organizations which they play a role, and we need to see their responsibilities and their activities separately. So understand the role of International Financial Reporting Standards, IFRS. So what actually IFRS are and what is the role of accounting standards. But before we move on to learn more about IFRS and these organizations, let's first discuss few fundamental concepts. Let me give you some background. For example, I always say that there's a difference between the word occupation and profession. Occupation is anything which you do, and occupation does not need any knowledge or formal education. It does not require degree or diploma, and it does not require any form of license or permission. So occupation is something which you can do very freely. Example could be photography. So you can become a photographer without any university degree. You can start it from tomorrow and you do not need any permission or license from anyone. Another example of occupation could be a carpenter. If you want to start your furniture business, you want to make furniture, you want to work as a carpenter, you can do it from tomorrow. Nobody would ask you, nobody would require you to have some license or permission for that, and you don't need a university degree or education for that. So occupation is something which is very free to choose and it's very informal thing. Profession, on the other hand, is a much more serious thing. Profession needs a formal education, then a degree or diploma as an acknowledgement of your knowledge, and then a license as a permission to work. So what are the examples of profession? For instance, medicine is a profession. To work as a doctor, you must go to a medical university, you study there for 4 or 5 years, then you take exams, you get degree or diploma, which is the acknowledgement of your knowledge in the field. Then you apply to some Ministry of Health and they give you permission to work as a doctor. So that is your license. So medicine is a profession. Similarly, engineering is a profession, or law is a profession. To become a lawyer, you must go to some university and you do complete your degrees. So profession is a serious thing. Now accounting is also a profession. To become an accountant, you must have a formal education, you must have some degree or qualification, and you must be registered with some organization to act as a registered accountant, an accredited accountant. So this is the difference between accounting and profession, and we should understand that accounting is a profession. Sales is not a profession. Anybody can become a salesman. If you have some good communication skills, if you have convincing abilities, if you are good in creating or developing relationship with people, you can go and work as a very good salesman, and you don't need to have some proper degree for that. But accounting is not like that. You cannot become an accountant without having the technical knowledge of that. So accounting is a profession. Then we discuss about the difference between law and regulation. Now, law is something which is made by the state and which is implemented with power, which is enforceable. Law is not something your choice that you may or may not accept it. You have to obey the law, and anybody who does not follow the law or does not obey the law, they are punished. So law is a strict thing. Regulation or standard, on the other hand, it is not law. Regulations are not enforceable with power. Regulations are regulation you can consider as the best practice. It's the working standard, how the job is done, how the job is performed. So standards you have for different professions. Like in each profession there are standards. Now what is the purpose of standard? Because you talk about any profession like medicine or engineering or accounting, and there are members of those professions, like you have got doctors or engineers or accountants. So these members of the profession, when they perform their duties, now they have been allowed by the state to perform the duties, they have been given the license, but the state does not monitor their activities and the state does not provide them guidance how to perform their duties. For instance, if there is a doctor, so he has a permission to work, but how is he going to treat his patients? What type of tests he will do whenever he gives some injection or some medicine to the patient? What preliminary assessment he would perform on the patient? That is not monitored or guided by the government. That is guided by some independent organization which tells the work practices, the work standards, how the job is to be performed. The same goes with engineering. So in engineering, when engineers, they construct some buildings, so within the building structure, what type of concrete, what type of metal and bricks and whatever are the composition of the construction materials, all these are given by some standards, and these are called these are so these are not laws, these are standards. Standard means the best practices. Similarly, we have got accounting as a profession. And in accounting, when accountants, they perform their duties, how accountants should do the financial reporting, how the accountants should handle or treat the financial transactions, these should also be given by some standards. So there are some independent organizations in the world, just like you can imagine International Association of Doctors, probably International Association of Engineers. So this International Association of Engineers, they are giving engineering standards. These engineering standards are the guidelines for the engineers to perform their duties up to a certain level of quality. And those engineers, when they are performing their duties, they keep in mind that they have to follow these standards. And when they follow these standards, ultimately the quality of their work is improved. So it is to improve the quality of the work and to create some form of standardization in work. Now we are accountants. We are also guided by some sort of standards. Otherwise there are thousands and thousands and millions of accountants. Everybody would be doing accounting in their own way, which would be very difficult. So there should be some rules, there should be some standards which all accountants should follow, so that the quality of the work is maintained and the uniqueness of the work is maintained. So I'm sure that you understand the difference between law and standard. So standards and regulations, they are not enforceable with power. These are not laws, these are best practices to control and monitor the quality of the work. Difference between IAS and IFRS. I'm sure that you people have heard both of these terminologies. IAS, it stands for International Accounting Standards, and IFRS, it stands for International Financial Reporting Standards. Now what is the difference? Now before I explain you the difference, let me take you to the history. I go back to the time period 1973. Now that was a time period of huge globalization. A lot of companies were expanding across the globe. American companies were moving out in Europe, and European companies moving out to Asia, etc. So when a lot of international trade was being done, investments were made, joint ventures and takeovers and acquisitions. So whenever you do trade with some other business, with some other entity, you want to do business, you want to make investments, you want to make partnerships, you want to do whatever business, you need to exchange information. And the information which is exchanged, it is one part of information is financial information, and financial information, it comes in form of financial statements. So what was happening that companies in different countries, they were exchanging their financial statements with each other, but those financial statements were prepared using different set of rules, because in country A they were using a different pattern of accounting, and in country B the accounting rules were different. And when accounting rules were different, so the financial statements which were prepared under different accounting rules were difficult to be understood by the accountants. Like imagine I take your financial statement and you take my financial statement. When I see your financial statement, I see that there is a profit which is shown as 1 million. I'm not sure if this $1 million profit is correct or not, because I don't know how did you come up to this number. I don't know how did you calculate this number. So I have doubts on this $1 million number, because I'm afraid that if I calculate in my way, it might be different. Because in your country you say that financial statement should be like this. In my country I say no, it should have some other components. I say the depreciation should be calculated in this way, but you calculate depreciation in some other way. I call something a non-current asset. You say no, it is not a non-current asset. I say the balance sheet format should be, so my balance sheet format could be different from your balance sheet format, and my income statement structure could be different from your income statement structure. So all of this, it created confusion between the businesses. So in 1973, what they decided to create some unique set of accounting standards which must be followed by the accountants all over the world. So in 1973, an organization was created. Its name was IASC, International Accounting Standard Committee. And the purpose of this International Accounting Standard Committee was to create and develop a unique set of accounting standards which must be followed by the accountants and the businesses all over the world, so that everybody should be speaking the same accounting language. Everybody is making financial statements following the same rules, and when you follow the same rules, of course these would be understood easily by everyone. So we created an organization in 1973, and their job was to give accounting standards. And they started giving accounting standards like IAS 1, International Accounting Standard number 1, IAS 2, International Accounting Standard number 2, and so on. Now IAS 1, International Accounting Standard number 1, what does it tell us? So if you remember, we said that there are 5 financial statements: income statement, balance sheet, and cash flow, and equity and notes. This is what we discussed in chapter number 1. Now, why do you say there should be 5 financial statements? Why not 6? Why not 4? Because IAS 1, it told you that there should be 5 financial statements. And then within your financial statements, you have current assets, non-current assets. In the balance sheet, you use the word equity and liability. So where did these words come from? All of this is a terminology of IAS 1. So IAS 1, it talks about that how many financial statements you should have and what should be the structure and format of those financial statements. So that goes first standard. Then you've got IAS 2. IAS 2, it deals with inventory. So we already have discussed this word inventory in chapter number 1. So if you have got any question related to inventory, the valuation, the revaluation, or whatever comes to your mind which is related to inventory, where should you go and find answer? You should go to IAS 2 and find answer there, because IAS 2 covers this topic. Similarly, we talked about tangible non-current assets, land and building, property, plant, equipment. So this topic is covered in IAS 16, International Accounting Standard number 16, tangible non-current asset. So if you have got any question related to tangible non-current assets, you would check IAS 16. So like you've got IAS 1, 2, 3, 4, 5, 6 and so on, whereas each standard is dealing a specific subject area, a specific direction. So IASC, International Accounting Standard Committee, it continued its work until 2001, and it issued 41 standards, IAS 41. But then what happened that in 2001 they created another organization, and its name was IASB, International Accounting Standard Board, and the role of this organization was much wider than the IASC, and it was like, you can call it like an improved form of IASC with more power, more authority, and a wider scope. And IASB, when it was created, so it was decided that IASB will continue the job of IASC. IASB will continue to issue the new standards, but there would be two conditions attached. One condition is that the new standards which would be made by IASB, they would be called IFRS. And the second thing which was agreed was that the new IFRS, they will slowly and gradually replace the old IAS. So IASB will continue to give new standards, and they will name them IFRS, and the IFRS series will gradually replace the old IAS standards. And this is exactly how it has worked out so far. So after 2002, IASB started giving standards and started cancelling out old IAS standards. So there were 41 IAS standards. Today we've got only 26 left, because many of them have been replaced by the new IFRS. One example I can give, like that there was a standard called IAS 18, which was revenue. It was cancelled out 5 years ago, and it was replaced by a standard called IFRS 15 revenue. So a new IFRS came in for revenue, and the old revenue standard was cancelled out. Similarly, a new standard for IFRS 9, which is financial instrument, it has replaced the old standard IAS 39 it has replaced the old standard IAS 39 financial instruments. So this process is a continuous process, and probably in next 5 to 10 years, all of the old IAS standards will be cancelled out, and you will have only IFRS. So IFRS, you can consider that it is a change of the name, but all of the main fundamental principles, they remain same. The accounting conventions, they remain same. And you should also remember that if in case there is some kind of contradiction between IAS and IFRS, IFRS will prevail. IFRS will have an upper hand. So now what do we have? We've got some 26 IAS standards and 16 new IFRS standards. So we are using both of them because some topics are covered by IAS because they have been developed over a long period of almost 30-35 years. And then some topics are covered under the new IFRS standards. So if I talk about financial instruments, I am taking help from IFRS 9. But if I have to deal with my tangible non-current assets, I check with IAS 16. So I've got both of them in my hand. So this is some background about IAS and IFRS. This actually is not given very much detail in your book, but I have explained you in so much detail because this is something which accountants should know, and because they miss out some time on this topic in the book. But accountants should be, well aware of this background and this history. So this is what I have written it here. IASC, it was created in 1973 and they gave 41 standards. Then you've got IASB in 2001 and I have already explained it. So let's move forward. What is an accounting standard? So a standard has 4 areas of focus. Now you should understand that an accounting standard, it is a long document, sometimes 70, 80 or 90 pages in length. And you might be thinking that what is this 70, 80 or 100 pages? What do they include? What is inside? So there is a very set structure of each standard. So each standard, it follows 4 areas. It focuses in 4 areas of direction. Number 1 is called recognition. Recognition means to recognize some accounting transaction. If an accounting transaction takes place, so you need to understand that does this transaction belong to you or not? And if it belongs to you, does it belong to the current period or to the past period? and if it is there, what it is exactly. Is it your income or expense or asset or liability? What is it? So recognize means to understand the nature of the any transaction. It could be my liability or it could be my income. Now here I would like to give you an example that how do you recognize a transaction. It is under a concept of substance over form, which we will learn in chapter number 3, but example I can give you here. Imagine that I sold you my car for $20,000 and I've given the money, I've taken the money $20,000 and I've given you the keys of the car. But then there is a and for that purpose I've given you the sales invoice, whatever it is, and we made a contract and we handed over and we exchanged cash and we exchanged the car. But then within the contract there is a term which is written and signed and agreed between you and me that after 1 year I will buy this car back from you. I will take it back from you for $21,000. Now understand please, I'm selling it to you for $20,000 with this understanding and this agreement that after 1 year I will take it back for $21,000. Now that is something which creates a doubt, because there is no sales transaction in which the seller makes a commitment of taking it back and even at a higher price. Why would I buy it back from you and why would I pay you $1,000 more? I mean, in essence, after 1 year, the value of the car should be less than 20,000. And why I'm paying you 21,000? So actually, if you see the substance of this transaction and if you try to analyze, it is not a sales transaction. Although we created it as a sales transaction and we made a sales invoice, but in reality, it is not a sales transaction. In reality, it is a loan transaction, because what had happened that I probably have asked you that give me 20,000 loan and you said, okay, give me your car as a mortgage. And when you return me back the money after 20,000, I will give you back the car. This is what would have happened. And that $1,000 extra, because I took 20 and I'm paying back 21, is the interest cost. So now when you see it in detail, you understand that on the face of it, it looks like a sales transaction, but in reality, it is not a sales transaction. It is not a revenue transaction. It is a liability. It is a loan transaction where I am taking a loan from you. So this is how you recognize it. So now we recognized it that it's a liability transaction. It's a loan transaction. So this is what you call the recognition of the transaction. Number 2 is called measurement. How do you measure it? So today, if I'm taking this money from you 20,000, I promise to pay you back 21,000. Now, how much should I record in my books? That is the measurement. Recognition. Okay, I recognize it. It's my liability. The next question comes, how much is it? Is it 20,000 or 21,000? So what should go in my books? The answer is, it is 20,000. I promise to pay you 21,000, but that only after 1 year. As of today, when I'm taking 20,000, and as of today, when I'm writing it in my books, my liability is only 20,000, because 1,000 interest will become due at the end of the year. It is not my liability today. So this is the second part which you call measurement, and we found and we got the answer that our liability is 20,000. Third thing is presentation. Okay, we agreed that it is our liability. We agreed that the amount is 20,000. Now the next question arises, where should we show it? Should we put it on income statement or balance sheet or cash flow or equity? Where should we show it? The answer is that it is a liability, and the liabilities, they go to the balance sheet. And if it goes to the balance sheet, where exactly should I write it on the balance sheet? So I have to pay it within 1 year. So it's my current liability. So we understood the presentation that it should go to the balance sheet, it should go to the liability section, and it should be written under the current liability section. We discussed already the difference between current and non-current liability in our chapter 1. So that is the presentation issue. And then comes the disclosure. Disclosure means that additional notes, some kind of additional information which you may provide about any certain activities or transactions. So any standard, they focus on 4 areas. 1, 2, 3, 4. First, the recognition of a transaction. Second, the measurement of transaction. Third is the presentation issue. Fourth is the disclosure note. So this is how you see the structure of any accounting standard, what you are looking at or what the standard is explaining and focusing at. So overview, we've got regulatory framework. So in regulatory framework, the first thing is we has IFRS Foundation, and under the IFRS Foundation we have got IASB, International Accounting Standard Board. IASB is the main organization or the main body which is responsible for issuing the accounting standards. In IASB there are 15 members, we call them the board, and the directors, there are 15 board members, and together they approve any accounting standard. There is another organization under IFRS F, under the foundation, which is called Advisory Council, IFRS AC, IFRS Advisory Council. The role of the Advisory Council is to provide advice to IASB. They provide advice on agenda, and they are generally assisting the IASB in the standard setting process. They are not responsible for that. They are only responsible for providing advice. And then you've got IFRS IC. IC is Interpretation Committee. Interpretation Committee has got a very important role because they interpret the standards which have been made by IASB. So IASB made the standard and IFRS IC, it interprets the standard. Interpretation means that sometime when you create a standard and then you apply it in different practical situations, so there could be some kind of contradictions, there could be conflicts, there could be gray areas. So any such additional information is provided by IC. It is also possible that sometime the standard does not provide complete information on some area. There is something which is missing. So any additional guideline or any additional guidance can come from the Interpretation Committee. So Interpretation Committee, they also issue annexures, and those annexures, those interpretations, they become part of the standards. They are the secondary to the standard. So first you see the standard, and if you are not clear, you do not get proper guidance, then you see the interpretations which have been issued by the Interpretation Committee. Also, you should understand that these IFRS standards, they are applied in more than 120 countries in the world, and in each country there are different national laws. So whenever you do convergence, whenever you do application, whenever you do transitions and you try to apply the IFRS in some local environment, there are always issues, there are always areas in implementation, and those issues, those areas and those problems, they are handled with the Interpretation Committee interpretations. So this is the structure. You should remember that IFRS F, International Financial Reporting Standard Foundation. This is the foundation main role is, it is like a parent organization. It dominates all three of them. It makes the budget, it monitors the activities, it gives them the agenda. It is a monitoring and supervising body. IASB is the actual working body for making the standards, whereas Advisory Council provides advice and Interpretation Committee provides interpretations. So this is the structure of, this is your regulatory framework. This is exactly what we call regulatory framework. Then we have standard setting process. Now how does the IASB works? What is the process of creating a standard? So the first thing you've got is called consultative group. The job of this consultative group is to identify the issues. Identify the issues means that in which direction we should create a new standard or which old standard we should revise. So you should remember that IASB is doing two things. IASB is issuing the new standards, as well as IASB is improving the existing standards. So whenever there is, the consultative group, which consists probably of 2 or 3 members, they identify the agenda, that what should be the agenda, which standards they need improvement, amendments, and which standards they should create new. And that agenda is submitted to the board, the IASB board, which are 15 people. 8 members, they approve it, and when they approve it, they create a steering committee. So again, a steering committee consists of 2 or 3 members of IASB. So there are 15 members within IASB, and you cannot allow or allocate all 15 people to work on one assignment. So we have got one assignment given by the consultative group, It has been approved that we need to work on that. We create a steering committee, a group of 2 or 3 members who are going to actually work on that assignment. And then they prepare the discussion document, which is called DD. So this discussion document DD, it can be considered as the first draft of the standard, as the initial version of the standard. It is submitted to the board. If 8 board members they approve it, then it becomes ED, which is called exposure draft. Exposure draft is again reviewed, and then 8 board members they approve it, and it becomes an IFRS. Now you should remember that starting from here until going down there, it's a long process. Usually it takes several years, sometimes 1, 2, 3, 4 or even 5 years. Usually a standard is developed in 1 to 2 years. Why does it take time? Because of course consultative group will meet several times. They all are located in different places and they have to arrange meetings and they make agenda. It goes to the board, then again some time is taken in the board meeting. Then steering committee start creating a standard, which is a very extensive document, because it is going to be applied all over the world. It comes to DD, discussion document, and then when you make the DD, you cannot expect that 2 or 3 people will write a document which entire world will follow. It does not happen. This DD is put on the IASB website for approximately 45 to 60 days. And it is open for all type of discussions and comments and feedbacks. So the audit firms, the auditors, accountants, other organizations, other stakeholders, everybody will see this DD and they will read it, they will give their feedback, they will make their comments, they will give their suggestions. Then they will take into account whatever is possible and they incorporate any suggestions, and then when it is everything is being taken into consideration, it becomes exposure draft, ED. And then when ED is there, it again goes to the website and it again remains there for 30 to 45 days. And again they make a review and collect the feedbacks and suggestions. And then when it is approved, it becomes IFRS. So it's a long process. There are some standards on which the IASB has worked almost literally like 6 to 7 years before they were finalized.